Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, so looking at the tape this morning, TMC is currently trading in a violently volatile band between 780 and 920. That puts the stock effectively up 45% year to date, and we are not even out of January. But the headline number isn't the price, it's the volume. We're seeing surges of over 20 million shares on peak days. And to put that in perspective, that just completely dwarfs the 3-month average. The liquidity has, well, it's exploded. The market is finally waking up to the catalyst we saw on January 21st, the NOA rule update regarding consolidated applications, and of course TMC's immediate filing for 65,000 square kilometers in the Clarion-Clipperton zone.
And this all begs the central question for anyone watching this ticker. Is this just a momentary gamma squeeze driven by market mechanics, or are we witnessing a structural repricing of the asset from a speculative mining stock to a geopolitical derivative?
And I certainly see the price action. It's impossible to miss. But I think you're mistaking a dangerous technical dislocation for fundamental value. I mean, this rally has all the hallmarks of a squeeze that's masking severe international legal risks. You call it structural repricing, I call it a liquidity vacuum that's being driven by market mechanics completely divorced from the reality of international law. The market is, well, it's effectively pricing in a United States first victory lap while ignoring the fact that 169 nations consider this move to be a violation of the common heritage of mankind. We're just watching a stock chart go vertical because of leverage and trapped shorts, not because the business case has suddenly become bulletproof.
I understand that caution, I really do. It's the prudent view. But the divergence in the data suggests this is something more durable. If you look back at 2024 and 2025, TMC was tethered to the lithium and battery metals indices. It traded in lockstep with the sector. When lithium prices crashed, TMC crashed. When the sector rallied, TMC rallied. That link has been completely severed. I mean, look at the peers right now. Lithium Americas is up maybe 3% year to date. MP Materials is up 11%. TMC is up 45%. This is a decoupling. The market has realized that the paralysis of the International Seabed Authority, the ISA, is no longer the bottleneck. By utilizing the Deep Seabed Hard Mineral Resources Act of 1980, specifically this new consolidated application pathway, TMC has shrunk their regulatory timeline from a decade of bureaucratic limbo to potentially 18 to 24 months. That is regulatory alpha, plain and simple.
It's certainly an aggressive interpretation of the regulatory landscape to call it alpha. It might be regulatory arbitrage. But before we declare this a victory for, smart money, we have to look at who is actually buying this stock right now. You have a float that is very tightly held by insiders and strategic partners, like Allseas. Then you have 28.5 million shares sold short as of mid-January. That's roughly 13% of the float. The days to cover ratio was sitting at 3. So what we're seeing isn't necessarily institutional belief in the DSHMRA legal theory, it's a forced feedback loop. Short sellers who are betting on a bankruptcy or a delisting are being carried out on a stretcher. And market makers are short calls at the $10 and $12 strikes, so they have to buy stock to hedge. This is just artificial price inflation, not some genuine discovery of value.
Okay, let's dig into that mechanics argument, because I'm not convinced by the just a squeeze line of reasoning. It really comes down to where the volume is transacting. If this were purely a retail meme stock frenzy or a panic cover by small funds, we'd see it all on the lit exchanges, the NASDAQ, the NYSE. But the data shows that 35 to 40% of this January volume is transacting in dark pools.
Okay, for the listeners who don't spend their day in the order book, let's just clarify that. Dark pools are off-exchange venues. They're used by large institutions to move blocks of stock without displaying their order to the public market until after the trade is done. It's designed to prevent slippage when you're moving size, right?
Exactly. You don't see retail traders sweeping dark pools. You don't see small shops doing that. That is institutional accumulation. Someone big is stepping in. Furthermore, look at the VWAP, the volume-weighted average price. Every time the stock dips to $8, it gets bought up aggressively. That is algorithmic accumulation. Institutions are front-running a potential federal funding announcement. They are betting that the NOAA application is just the first step in state-sponsored de-risking. They aren't just covering shorts, they are building a position.
But even if institutions are rotating in, they're buying into a legal minefield. Let's talk about that America alone strategy, because that is what this NOAA application represents. The U.S. can issue a license under domestic law, sure. The DSHMRA allows it. But the 169 parties to UNCOLS, the Law of the Sea, they view the Clarion-Clipperton Zone as international jurisdiction. If TMC mines there without an ISA contract, it's legally characterized as stealing resources. And you mentioned European automakers. Do you honestly think a German car manufacturer is going to sign an offtake agreement for nickel that the European Union considers contraband? The legal risk here isn't just about getting the rock out of the water. It's about who outside of the U.S. military-industrial complex is even allowed to buy it. You limit your customer base to one country.
But that one country is the largest economy in the world and one that is desperate for these materials. But before we get to the geopolitics, I want to stick on the market mechanics for just a second longer because there's another signal flashing red. You mentioned the short interest, and I agree it's a factor, but let's look at the options market volatility. We're seeing a skew inversion.
Explain that for the audience.
Okay, so typically in a normal market, puts, which are bets on the price going down, are more expensive than calls. People pay for insurance to protect their downside. Right now, the script is completely flipped. Out-of-the-money calls at $10 and $12 strikes are trading at a massive premium over the puts. The market is paying up for upside exposure. That tells me the smart money isn't hedging against a crash. They're terrified of missing a parabolic move upward. They're grabbing leverage because they think the announcement of a federal grant or loan is imminent.
Which is exactly my point about the gamma squeeze. When everyone buys those calls, the market makers on the other side are short gamma. They're the ones selling you the call. So as the price rises, those market makers have to buy the underlying stock to remain delta neutral, to balance their books so they don't lose money on the trade. It creates a self-fulfilling prophecy. Price goes up, market maker buys, price goes up more. It has nothing to do with whether the nodules are actually coming out of the water. And regarding the short interest, you have to consider the pain trade. With borrowing costs spiking, the shorts are trapped. But once that covering is done, once that artificial buying pressure evaporates, what supports the price at $9?
What supports the price is the valuation relative to the asset. Let's strip away the technicals for a moment and just look at what they actually own. The net present value, the NPV, of just the Nordy project is estimated at $23.6 billion. That's the value of the metal in the ground, or, well, on the seafloor, minus the cost to extract it, discounted back to today. As of this morning, TMC's market cap is roughly $3.4 billion. That means it is trading at 0.14 times its net asset value. That is incredibly cheap for a resource of this magnitude. You typically see mining stocks trade at what, 0.4 to 0.6 times NAV once they have a clear path to production.
But cheap is relative to risk. You can't compare a deep-sea mining project with zero commercial revenue to a producing mine. I mean, a theoretical MPV is just a spreadsheet until you actually sell metal. And that MPV assumes they can actually sell it at market rates without hefty legal tariffs or sanctions from the international community.
But let's compare it to the peers. Look at MP Materials. They're the U.S. champion for rare earths. They have a market cap of $12.2 billion. Look at Lithium Americas, sitting at $2.1 billion while still in construction. If this NOAA permit holds, and the United States' first policy indicates it will, TMC should re-rate to at least 0.5 times NAV. That puts the stock in the $30 to $40 range. The market is just beginning to price in the reality that TMC has 619 million wet tons of resource that doesn't require digging a hole in Nevada or dealing with the EPA on terrestrial land. It's sitting right there on the surface.
I have to push back on the financial health, though, because you're projecting massive future value on a company that is burning cash today. You're quoting NPV, which is a theoretical number based on future cash flows. Let's look at the actual balance sheet. Q3 2025 showed a net loss of $184.5 million. I grant you, a lot of that was non-cash revaluation of royalties. But the operational burn is real. They're spending money on ships, on lawyers, on engineering, and there is a ticking time bomb in the capital structure that we haven't even touched on yet, the public warrants.
The warrants are a financing tool, not a bomb. They're a standard part of the SPAC structure they came public with.
They are a dilution event. If the stock holds above $18 or even triggers certain clauses in the $10 to $12 range for an extended period, the company can force redemption. Yes, that brings in cash, potentially $280 million if fully exercised, but it floods the market with shares. It effectively caps the upside. The company is incentivized to pump the stock to force that conversion because they need the cash. They have about $165 million on hand as of the last report. The clock is ticking on their runway, especially with the legal costs of this whole Noah gambit. The higher the price goes, the more likely they are to pull the trigger on those warrants and dilute existing shareholders.
I view the warrant redemption differently. It's a bridge to production. If they get that $280 million, it funds them through commercialization, it removes the bankruptcy risk entirely. And that removes the short thesis. And frankly, the investors buying in dark pools right now aren't worried about dilution, they're worried about access to molecules. This brings us to the geopolitical aspect, which I believe is the real driver here. Have you looked at the correlation between TMC's price action and the prediction markets on Polymarket?
I've seen the data. It's becoming a proxy for conflict.
Exactly. There's a high positive correlation between TMC's stock price and the Polymarket contract for U.S.-China trade war escalation. There is also a very high correlation with Trump deregulation energy sector. The market sees TMC as the hedge against China's weaponization of supply chains. We saw what happened when Beijing restricted gallium and germanium exports. It sent shockwaves through the semiconductor industry. TMC is the insurance policy against that happening to nickel and cobalt. If the trade war escalates, the value of a domestic, U.S.-controlled nickel and cobalt source goes parabolic. It doesn't matter if the warrants dilute the stock by 10% if the underlying asset becomes a matter of national security.
But that hedge comes with kinetic risk. This is the scenario planning that keeps risk managers up at night. I mean, if TMC goes out there to mine under U.S. law outside of the UN clause framework, what happens if a Chinese research vessel decides to interfere? What happens if they park a ship right over the collector site? They would argue they're upholding international law against an illegal miner. This isn't just a trade dispute, it necessitates U.S. Navy protection. You're asking investors to bet on a scenario that could spark a naval incident. Is the U.S. Navy going to escort a mining ship?
The China threat is exactly why the U.S. government will support it. The resource quality, manganese at 28 to 30%, nickel at 1.3%, is strategic. We're talking about a resource that sits in the Eastern Pacific, closer to us than to them. The consolidated application covers 65,000 square kilometers. By filing this, TMC is effectively forcing the U.S. government to assert jurisdiction. It moves the dispute from a meeting room in Jamaica at the ISA to a direct diplomatic channel between Washington and Beijing. And given the current administration's stance on unleashing America's offshore critical minerals, the market is betting the U.S. won't blink. The U.S. isn't going to let China bully an American company operating under American law in international waters.
Look, I agree that the resource is high quality. Nobody disputes the nodule chemistry. The metallurgy works. The manganese sulfate production in Q3 2025 proved that. But you're describing a stock that is priced for conflict, not commerce. If we see a détente, if the U.S. and China reach a trade deal that guarantees mineral supply, the premium on TMC evaporates instantly. The stock collapses because the environmental opposition returns to the forefront. If peace breaks out, this trade dies.
But the trend is not toward détente. The trend is toward decoupling. That is why we're seeing the shift in the shareholder base. The ESG funds left in 2024. They dumped the stock. So who replaced them? Event-driven hedge funds, macro funds, family offices like Eris Capital. These are investors who care about asymmetric returns and geopolitical themes. They see a company that trades at a fraction of its peers like MP Materials, yet holds the key to the entire EV battery supply chain. They aren't looking for a safe dividend stock. They are looking for a geopolitical call option.
It is a binary bet on executive power. That's my fundamental issue. You're not betting on business execution. You are betting on whether the White House is willing to ignore international law. You are betting on the stroke of a pen.
And I would argue that in 2026, business execution is geopolitical positioning. You can't separate the two anymore. If you want critical minerals, you have to play the geopolitical game.
and TMC is playing it better than anyone else right now.
Let's wrap this up. From where I sit, TMC has become a binary derivative. The valuation is being distorted by a squeeze that will eventually end. And squeezes always end, usually violently to the downside. The legal peril is real. Europe may not buy the metal, and China may physically block the extraction. If the geopolitical temperature cools, this stock has a long, long way to fall. It's currently priced for a breakdown in international relations.
I see it as the only asset with the scale to matter. We're talking about 619 million wet tons. The market is correctly identifying this as a must-own call option for 2026. The decoupling from the lithium index proves it. TMC has graduated from being a mining stock to being a strategic asset. If you believe the U.S. is serious about supply chain independence, you have to look at this, regardless of the short-term squeeze mechanics.
We can agree on one thing. The stock has completely decoupled from traditional mining economics. It's now trading on regulatory alpha and tension.
Absolutely. It is the ultimate geopolitical derivative.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.